All right, today we are diving deep into the latest financial reality of an absolute industry titan, the Hartford. We're going to look right under the hood to see exactly how a massive legacy insurance company balances these mind-blowing billion-dollar profits against a landscape of rapidly evolving modern risks. It's this fascinating push and pull, historic performance on one side and existential peril on the other.
And to do this explainer right, we aren't looking at some polished PR spin or secondhand summaries. No way. We are pulling our insights straight from the source, their official Q2 2026 Form 10-Q filed with the SEC. We're unpacking the raw, unfiltered data from the quarter ending June 30th, so you can see exactly what management is whispering to their investors behind closed doors.
Here is our roadmap for this explainer. 1. The Q2 2026 headlines. 2. Where the money comes from. 3. Strategic shifts and sales. 4. Looming risks and exposures. And 5. The bottom line. Section 1. The Q2 2026 headlines.
Right out of the gate, the headline figure is just absolutely massive. For the second quarter of 2026, the Hartford reported a net income of $1.29 billion. Seriously, let the scale of that sink in for a second. Actually, keep in mind that isn't top-line revenue. That is pure net income, generated in just a single 90-day window by a legacy insurance carrier. Now, to put that billion-dollar figure into some much-needed perspective, it represents a huge leap from this exact same time last year. Back in Q2 2025, they brought in $995 million. So we're talking about significant year-over-year growth here. They didn't just tread water in a weird economic environment. They absolutely expanded their profitability.
Section 2. Where the money comes from.
So when you break down their $7.2 billion in total quarterly revenue, there is an undisputed heavyweight champion in their portfolio. Business insurance is their core profit engine, bringing in a staggering $4.2 billion in Q2 alone. I mean, it completely dwarfs their other segments. It pulled in more than double the revenue of employee benefits, which was at $1.9 billion, and easily outpaced personal insurance, which is sitting just over that $1 billion mark. Commercial policies are, without a doubt, the backbone of this whole operation. And getting a little more granular with that business insurance category, the raw data shows us exactly what's keeping the lights on. The biggest contributors to their earned premiums, workers' compensation at $933 million, and their package business at $718 million. By underwriting the daily, on-the-ground risks of America's workforce, they are totally dominating the commercial, blue-collar space. Basically, every time a warehouse runs a shift or a construction crew breaks ground, the Hartford is probably collecting a premium.
Section 3. Strategic shifts and sales.
Now, it wasn't just standard policy premiums driving all these crazy numbers. There was actually a major corporate maneuver hidden a bit deeper in the accounting. On June 3rd, 2026, the Hartford agreed to sell off Hartford Funds Management Group. Because of that strategic streamlining, a pretty significant chunk of their income has now been reclassified on the balance sheet as discontinued operations.
And you can really feel the financial impact of that strategic shift in this quarter's numbers. $318 million of their total Q2 net income came directly from those discontinued operations. That is up dramatically from just $57 million in the exact same quarter last year. So here's the crucial takeaway for us. A sizable portion of that super impressive year-over-year growth we just celebrated is actually from a one-time divestiture. It's not necessarily permanent recurring premium growth,
Section 4. Looming risks and exposures. Okay, so with tens of billions of dollars in total assets on the balance sheet and making money hand over fist, we have to ask, what does a giant insurance company view as the greatest existential threats to its own future? What are the perils that could actually derail all this financial momentum?
Well, according to the filing, Mother Nature is absolutely one of their top threats. And honestly, she doesn't seem to care at all about their carefully constructed actuarial tables. We're not just talking about one bad storm here. It's the intensity and frequency of everything. Thunderstorms, wildfires, flooding, hurricanes. The irony is, climate change threatens the very mathematical models insurers rely on to manage catastrophe risk in the first place. If long-term weather patterns just become entirely unpredictable, a billion-dollar pricing model based on historical data is effectively useless. That leaves them dangerously exposed. Beyond the volatile weather, they are keeping a very close eye on the roads.
The filing explicitly notes that autonomous vehicles, advanced automotive safety features, and ride-sharing platforms could fundamentally alter their entire landscape. Think about it. If AI eventually drives cars significantly safer than humans do, or if people just stop owning personal vehicles altogether in favor of ride-shares, the overall demand for traditional auto insurance could plummet almost overnight. It's a classic case of technological disruption threatening a legacy cash cow.
And that disruption isn't just physical, it's purely digital. They call out the very real risk of falling behind in the data revolution. Emerging tech like machine learning and predictive analytics are a massive competitive threat. If some nimble Silicon Valley tech startup successfully leverages big data and AI to assess risk and price premiums better than a legacy giant like the Hartford, well, their historic competitive edge could just evaporate. In the modern insurance game, whoever has the smartest algorithm wins.
Finally, behind the scenes, they are grappling with some intense operational vulnerabilities, chiefly the ever-present threat of cyber breaches and technology failures that pretty much plague all modern corporations. But their biggest hurdle? It might actually be uniquely human. They openly admit to the very real challenge of attracting and retaining specialized analytical talent. To fight that AI and big data war we just talked about, you need the absolute brightest technical minds. And the Hartford acknowledges how fiercely difficult it is for a traditional insurance company to win a talent war against big tech firms and trendy startups today.
Section 5, the bottom line.
The Hartford actually provides the most honest assessment of this balancing act right in their own SEC filing. They state, because forward-looking statements relate to the future, they are subject to inherent uncertainties, risks, and changes in circumstances that are difficult to predict. Basically, that's corporate speak for acknowledging that despite using the most sophisticated analytical models in the world and employing top-tier risk assessors, the future is still inherently uncertain and fiercely difficult to forecast.
So, the final question you should take away from this explainer is this. As climate patterns become more volatile and technological disruption accelerates at an unprecedented pace, can the immense financial strength and massive commercial footprint of legacy insurers like the Hartford weather the coming storms? It's an incredibly high-stakes balancing act between past performance and future peril, and it's definitely one we will be watching closely in their future filings.